Well, good morning to all of you. Thank you very much for coming to this panel, which is about the monetary policy frameworks in a world of low interest rates. Well, I guess I don't have to dwell too much in front of this audience about what motivates this panel. We all are very well aware about the great financial crisis and the need for very, very determined policy response from authorities. A lot of the way fell on central banks. They acted in consequence, and what we saw was an unprecedented policy response in terms of scale, scope, and speed. Basically, we can say that monetary policy frameworks have been pushed to unprecedented level. We're really trying to discover what are the limits of these monetary policy frameworks. And I would say at the same time that we have been seeing positive results in many different dimensions, but then there are some issues that I think at least invite very serious reflections from central banks, basically to determine if we are well prepared for what comes next, and also if we want to really achieve very important final objectives that many policymakers have. In terms of what have been the results of many of these policies, as I say, many of the news are very good news. I mean, obviously, we have economic growth that has been restored. Unemployment rate has been drastically reduced. Safety buffers in financial systems have been strengthened significantly. And I would say another very important issue is that if we think about the global financial crisis, the synchronicity of shocks, each one by itself would have taken a lot to fix. But in a way, through mostly monetary policy and financial policy, we managed to bring these beasts under control. Here we're talking about the fact that after the global financial crisis or great financial crisis, markets were panicking, markets were frozen. We had major illiquidity issues in many different parts. We had a tremendous collapse of credibility and confidence in many financial institutions. We had contagion across markets and across sovereigns. And of course, we have a very sudden collapse in GDP growth. So the fact that we managed to deal with all these aspects at the same time, I think is very, very important, and it pays a lot of tribute to what has been done. Now, at the same time, and we heard plenty in the last panel here in this room, there are still pending issues. There is a lot of frustration, I would say, about the fact that even though we have had economic recovery, this hasn't been as vigorous as everybody expected. Inflation has been persistently below objectives. Inflation sensibility to resource utilization is very low. Falling equilibrium interest rates eat into monetary policy space, exacerbating downside risks and potentially pushing equilibrium rates even further. What do we want as central bankers? Well, what we all wish is to have a robust convergence of inflation to levels that would allow for normalization of policies in the context of sustainable growth and financial stability. Now, what normalization means in this context is difficult to know. Probably we will have to move to a new normal, but I would say to have, let's say, a far more stable environment to conduct monetary policy. Many central banks, or I would say pretty much all central banks in advanced economies at different speeds, in different fora, are in the process of reviewing their monetary policy frameworks. And therefore, I think that to have this opportunity to discuss the issues in this very prestigious fora is really relevant. So just for the record, I'm Agustin Carstens, General Manager of the Bank for International Settlements, and I would like to introduce to you our panelists, very distinguished group of people with a joint characteristic or twin characteristics. All of them here are superb central bankers and at the same time very accomplished economists. So I think we can have a very lively discussion combining these two characteristics, technical proficiency, but at the same time addressing real-life issues for all of us here present. Let me introduce our panelists, starting, well, basically following alphabetical order. We'll have Ben Broadbent, Deputy Governor of Bank of England, Philip Lane, board member of the ECB, Matsumi Wakatabe, Deputy Governor of Bank of Japan, Caroline Wilkins, Senior Deputy Governor of Bank of Canada, and John Williams, President and CEO of the New York Fed. Just let me present to you, I would say, what the mechanics of this panel will be. First, I tried with some colleagues at the BIS identify 5 questions on the revised monetary policy frameworks that are broad enough that they are, first of all, they have to be meaningful. I remember discussing, thinking about monetary policy about a very important paper that many decades ago was written by Leonardo Auenheimer. In his acknowledgement, he said he gave thanks to Harry Johnson because he asked the relevant question. So I always like to think about what are the relevant questions, and I hope that these are the relevant questions, more than anything because it will give also room for the different panelists to elaborate on different arguments that they might want to make, what they think is important. Some sub-questions I would make at each of these questions, I mean variations on the main topic. So each of these questions will be addressed by 2 panelists, and around 5 minutes will be allocated to each of them. So that 5 times 2, that's 50 minutes or so. After that, we will give a few minutes to each one of them to react on what other panelists have said. And then at the very end, we will open the floor for questions and answers. So let's get going. So the first question that you have in front of you is stable inflation between 1 and 1.5 high enough? This is a broad question, but let me now go to the panelists and ask them a little bit more pointed question. Phil Lane, should central banks be concerned about inflation rates below target when accompanied by robust economic activity and low unemployment? Should they adopt wider target ranges for inflation or a benign neglect of inflation shortfalls, provided that these come in parallel with strong economic performance?
Thank you, Augustine. So I think at a point in time, in a purely static view of the world, of course, it sounds very good of low, good labor market and also inflation that's low because, of course, unexpectedly low inflation is essentially a real wage increase, if wages are ahead of the unexpectedly low inflation. So I encounter all the time, the sentiment, what's wrong with the current situation? I mean, that is a pretty widespread person on the street point of view. But I do think this is where the long horizon of central banks is so important, that we have to look beyond the kind of point in time viewpoint and really be concerned, because of course central bankers, even more than the typical economist, has to be gloomy and be concerned about the next negative shock. I think it's One interesting fact, and is that we now know it a lot more than we knew it already, but I think we really know it now, is downward rigidity, nominal rigidities are pervasive. Europe went through a pretty severe shock. Hardly any nominal wage cuts happened. In a more flexible labour market, including the Irish one, the hiring wage did move, but for existing workers, no. So, in terms of the body of evidence saying that wages are downwardly rigid, it's so comprehensive. We have to recognise that we do need to have a monetary policy available. Of course, if fiscal policy were fully available, maybe there's some substitution. But we do need monetary policy to be available to deal with downturns. And so making sure that inflation is high enough in normal times that, if you like, the kind of interest rate in the good years is high enough to provide room for cutting and to provide, make sure that we don't turn too often to unconventional policies. I mean, I agree with Ben Bernanke's presidential address last night. It does provide extra room. But it's extra room. It's not the first I think set of instruments to turn to if there's a shock. So we're hired, I think, to have long horizons, and with that long horizon point of view, it's very important that we do get inflation back to where it should be. I don't disagree with Adam Posen in the last session about why exactly should be 2, but it's hard to come up with reasons to go far below 2. As a steady state number. But I think also what's interesting in terms of, the other thing I do think we probably should learn from this situation, where the reason why inflation is below target is the labour market has been more elastic than we expected. At one level, that's a very good news story, that we did have a lot of we turned out we could create more jobs than we thought. I mean, I know that that's true in the US. It's definitely true in Europe. That the surprise of the kind of point at which wage pressures kick in was so much lower than ex ante expected. That is a good news story. The flip side of that is maybe a regret that monetary policy was not more aggressive, at an earlier point. When that's the lesson, is that we should be more optimistic about the labour market, and therefore recognise that we should be more aggressive on monetary policy at an earlier point. So I think to me this is a little bit of a leading question, which is yes, at a point in time, but for business cycle management, we do need inflation to get back to the convention of 2. Whether 2 is exactly the right place, we can talk about it, but I don't think 1.5. That's a lot of policy space. From the amount we need to do with APP and other measures to get, say, 100 basis points of accommodation. If we can get 100 basis points of policy space just by nudging inflation back towards 2, I think for a long horizon, that's worth doing.
Excellent, thank you very much. Now let me move to Caroline. In many advanced economies, numerical inflation targets have remained broadly constant despite the changing circumstances. Even in Canada, where you go through a periodic period of revision, the target has remained at 2%. So should central banks try to create room for policy maneuver by raising the targets?
Well, it's a sensible question to ask. It's true, we have targeted 2%. Since 1995, many central banks are targeting something quite similar. And in fact, for quite a long time, it's served us very well. But with the neutral rate of interest having fallen so much, our estimates are that in nominal terms, it's in the 2.25 to 3.25 range. It does give us less room to maneuver. And that's an issue because the monetary policy tools that we have at our disposal outside interest rates may be less effective, especially for a small open economy like Canada. But also, it may force us to follow low-for-long strategies that might be effective at boosting demand, but may also, and probably also, exacerbate financial vulnerabilities and create boom-bust cycles. And so Definitely, it's a natural thing to think about. In our renewal of our inflation control agreement with the government, which we do, and we have done every 5 years since 1991, the last one we did was in 2016, and we looked precisely at the question of whether we should raise the inflation target to, say, 3 or 4%. And of course, it's not surprising that all our research showed that, yes, it actually would give us more room to maneuver. It would reduce quite a lot the probability of hitting the effective lower bound. And at the same time, it's a framework that people are familiar with. And so, there were some positives. But of course, you're not going to pick a monetary policy framework on that criteria alone, that it would make our jobs easier. You have to think about other things that relate to, well, how would that policy affect real people? And how would it affect them differently? And how would it affect your credibility? And is it feasible? And so on how it affects people, well, we know also from our research that a higher inflation rate would affect everybody, but it would be worse for people who are having lower incomes or are living on fixed incomes. With respect to feasibility, here we are wondering if we can get to 2%, and so one has to ask whether or not we could get to 3%. It's possible to adjust inflation expectations upwards, but our credibility is on the line in one sense in trying to achieve that. And I think the credibility is on the line as well in another dimension, which is if we do succeed, then you have to wonder, that'd be great for a while, but you have to wonder whether or not people would think, well, if not 2, but 3, why not 3 and 4, and where would that lead? And so we decided ultimately not to go that way. Now, in this particular renewal series that we're doing now that's set for 2021, we are doing a full horse race of different monetary policy frameworks because it's not just raising the inflation target that could achieve better outcomes in terms of our room to maneuver. You could think of other strategies, and I'm sure we'll talk about them here, that are make-up type strategies, price level targeting, average inflation targeting, switching your regime to price level targeting when you feel like you need to at the lower bound. And so that horse race is going to be model-based, the criteria will be clear, and we'll be publishing that research as it becomes available throughout the year. But certainly those are interesting avenues to pursue, as well as the tools to gain better confidence in them. One of the things that come to mind are there other things that we should be thinking about at the same time, and I think the policy mix between fiscal policy and monetary policy, as well as macroprudential policies, are needed. As I said, we haven't fully concluded anything, but we know already from our consultations with people that Canadians actually don't like the idea of higher inflation, not surprising. And we also know that it's a regressive tax and that more sustainable policies would take a different tact, many of which we talked about were talked about in the previous session, that raise our star and living standards at the same time.
Well, thank you very much, Caroline. Now let's move to the second question. I mean, in the first one, we addressed the issue about what the aim should be in principle. Then is, well, how are we really able to go and get to that target? So can central banks affect inflation when it is low, and through which channels? In the previous panel here, the topic was discussed about Japanification. And what was really surprising from that panel is that no representative from Japan were present. So I think it's a matter of justice to give Bank of Japan an opportunity to react. And as a matter of fact, I think this is the perfect question for Masasuri Wakatabe to address these issues and give us a sort of Bank of Japan's point of view, or at least your very own personal view. So please go ahead.
Okay, thank you very much. First off, with the Japanification. Now, after all, Japan is the birthplace of Japanification, so I think it's my duty to say something about it. I think it was Simon Kuznets, who said that there are only 4 economies in the world: advanced economies, developing economies, Argentina, and Japan. So Japan used to be a sort of a success story, which has successfully transited from the developing world status to the advanced economy status. Now we have Japan as a cautionary tale. So let me just say three things. I think that's the first point is that deflation is bad. Okay, so anything or everything the central bankers try to avoid deflation is exaggerate. Believe me, I am the only person on the panel who experienced Japanese deflation firsthand. Okay, and of course, personal experience can be very deceiving or misleading, but I must say, that the deflation is very bad. That if you take a look at the data, real GDP growth rate per working population or per capita hasn't been so bad for Japan. So it's about, actually it's higher than the US, the record. But that's actually not the point. Actually, it's with that kind of record, actually we could have done better because the deflation actually brought a higher unemployment rate. And higher unemployment rate was associated with lots of human and social costs as well. So that's we now talk about labor market ice age generation. Those who entered into the labor market when the deflation was at the highest and unemployment rate was the highest. So in that sense, the deflation is bad. And second point is, of course, that would give us food for thought about the sort of economics or economic theory. We used to think about dichotomies, okay? So real variable versus nominal variables, and short-run versus long-term run, and also cyclical components versus growth components. All talks about sort of secular stagnation highlights that these dichotomies can be misleading. It's a debatable point that how much we can sort of delineate these two things. But the very reason why central bankers aim for the price stability is that somehow nominal variables matter, so through nominal rigidities or other channels. So in that sense, that's the second point. And third point, if I may, is that this Japanification could happen to other countries. So in that sense, it's quite right for other central bankers and policymakers to be concerned with Japanification. So back in the 1980s, Japan was the economic superpower and powerhouse. And but Japan fell into this sort of deflationary trap. Having said that, coming back to the original question. Okay. I must say that still central banks can affect the inflation. It's not 100% kind of control we have, but I think that the precisely Japanification episode shows that after 2013, the Bank of Japan and the government tried to end and conquer deflation. And after that, the sort of the average inflation rate in Japan has jumped by 1 percentage point on average. Now, this improvement may not seem to be a great sort of a huge step or great improvement by your standard. But I think that's really remarkable because after the global financial crisis, other countries, other economies have experienced a lower inflation rate. But I think that after 2013, Japan actually succeeded partly the Japanification. So in that sense, that we can still, affect the inflation. But having said that, we haven't yet reached the 2% inflation target, and it is taking time, and all sorts of considerations about the stickiness of the price and the stickiness of inflation expectations matter a lot. So, for example, when the people experience a deflation, the expectation, inflation expectations would be sort of lowered, reduced. And we see, according to some research by Japanese scholars, the younger cohort, younger generation of the Japanese people actually don't seem to have higher inflation expectation. So that's clearly there is a message. I think history matters. And also preemptively, I think that central banks should do everything to avoid deflation. Thank you.
Thank you very much, Masasumi. Now, John, the question, can central banks affect inflation when it's low and through which channels? Certainly inflation expectations play a very important role. So what do we know precisely about the formation of inflation expectations? John.
Sure. First of all, I have to give the normal Fed disclaimer that everything I say reflects my own views and not necessarily those of the FOMC or anyone else in the Federal Reserve. Okay, so we did that. Obviously, the theme of inflation expectations is really critically important. My view is that anchoring inflation expectations has been one of the great success stories of central banking over the past quarter century. Both in theory and in practice, especially over the past decade, we've seen this well-anchored inflation expectations temper inflation responses to shocks and enhance the ability of monetary policy to stabilize both the real economy and prices. And so, to my mind, it's of paramount importance that central banks preserve and indeed strengthen anchored expectations at our target levels. The emergence of very low R-star and low inflation globally present new challenges to maintaining well-anchored inflation expectations. Much of the preceding quarter century was about bringing inflation expectations lower following the high inflation experience preceding that. Today, it's really about keeping inflation expectations from getting too low. Now, it's often claimed that we don't really understand what determines inflation expectations, but in fact, researchers have made significant progress on this topic in recent years. Research using a number of approaches, including behavioral economics and models where people learn and filter the data over time, have found that the history of inflation matters for inflation expectations, echoing my colleagues' comments. Importantly, this isn't the same as traditional adaptive expectations models that we were probably taught in school decades ago, where inflation expectations are some kind of mechanical weighted average of past inflation. So the research from both the behavioral economics and more generally argues inflation expectations depend critically on the actual historical behavior of inflation, which of course is shaped by the conduct of monetary policy. So recent preliminary work using the New York Fed Survey of Consumer Expectations highlights a number of aspects of how inflation expectations have evolved over the past 6 or 7 years. This is ongoing work now is based on a behavioral model due to Momadir and Nagel, but here we're using the SCE data that the New York Fed collects. If you look at this data through the lens of this analysis, long-run CPI inflation expectations have fallen nearly 0.5 percentage point over the past 6 years to about 2.25%. That's roughly consistent. This 2.25% CPI inflation is roughly consistent with the Fed's 2% long-run inflation target that's based on the personal consumption expenditure PCE measure. In looking into the data, the decline in longer-run inflation expectations we're seeing in the U.S. reflects two ongoing developments. One is the very low CPI inflation. This is the history matters part. We've seen CPI inflation over the past 6 years that's well below historical averages, well below 2%, and that affects in the survey data. We actually see that affecting all cohorts. We talked about the young and the older generations. All of them are changing their views of long-run inflation expectations based on the fact that inflation has been lower. So everybody's adjusting their views. But importantly, this experience of the last 6 or so years affects the different demographic groups somewhat differently. So demographic shifts where are older cohorts that have still carry with them, and I have to admit I'm one of the older cohorts, still carry with us the experience of the late 60s and the 70s and early 80s when inflation was high. So that's still part of our DNA, if you will, and that shows up in the survey data. So as that group ages and leaves the sample, they're being replaced increasingly by younger cohorts who've never experienced high inflation at all. And so we see two things happening in the survey data. One is the younger folks, just like we talked about in Japan, younger cohorts have much lower inflation expectations and much more sensitive to the incoming data than the older cohorts, or I guess I should say the more mature and wise cohorts, where we are still carrying with us these older experiences and adjust perhaps on the margin a little bit less. So there's two, I think, important implications for this line of research and this evidence, which I think is not just true of the US in our survey, but obviously has broader implications. First, if inflation continues to underrun our target, levels like it has in the past 6 years, this downward trend in inflation expectations will likely continue. With inflation expectations falling well below target consistent levels. And importantly, this reflects two developments that are happening. One is this mechanical aspect that people are seeing lower inflation and everyone's adjusting kind of their perception of what normal inflation is, but also this demographic shift of the young who've never seen high inflation kind of becoming the more predominant group in our labor force, in our economy, and the people who have the higher inflation expectations, say, exiting from that. So there's this demographic trend pushing it down, along with just the fact that people would be lowering their views. But the good news here is that there's still time to avert this fate of a continuing decline in inflation expectations. The young are impressionable. They will change their views based on the evidence, based on the research. So if inflation is sustained at target consistent levels, a further downward trend in inflation expectations can be forestalled despite these demographic trends. So I think the punchline from a lot of this research on inflation expectations, obviously in the central banking world, is we've always thought that it's important for us to be committed and accountable to achieving our goals, and we need to act and communicate in a way consistent with that. But I think what this evidence highlights is the fact that inflation expectations are not just based on the actions of the communications of central banks and the commitment to targets, but really do depend on whether you achieve those targets consistently over a long period of time. Thanks.
Thank you very much, John. Now let's move to the third question. Should central banks reconsider flexible inflation targeting? Ben, in particular, should further inflation shortfalls accelerate the discussion on viable alternatives to flexible inflation targeting? And in given case, what forms could those alternatives take? Ben, please.
Thank you very much, and good morning, everybody. I'm going to talk a little about something that John touched on, namely low levels of R star, which I think present a challenge for any monetary policy framework. So if the thrust of the question is that somehow we can, short of having a much higher inflation target, or having had one maybe all along, which would have been better, some of these alternatives, I think, or many of them, should I say, will run into this problem of having low structural interest rates. And the thing I want to emphasize there is how long, at least in some jurisdictions, this trend has been going on. So I think I too would count myself as part of the mature generation. Now, Philip and I turned up at graduate school at exactly the same time in the fall of 1991, so long ago that I don't think even email existed then. And at that time, in my country, in the UK, if you'd bought an index gilt, a 10-year index gilt government bond, inflation-proof, you'd have been getting 4.6% in real terms, over 7% in nominal terms. And when the UK dropped out of the European exchange rate mechanism, sterling fell out of that the following year, and the UK government scrabbled around for alternative and came up with inflation targeting. Only a few other central banks were doing it then. People thought that was the normal level of interest rates. That in nominal terms, if you were to stabilize inflation at 2%, say, you might need nominal interest rates of 6-7%. That would be the sort of level you'd be looking for. And then over the first decade, we're talking a period of time long, long before the financial crisis or even the financial boom that preceded it, that number came down. And suddenly people thought, well, actually, it turns out you only need maybe a little bit less than 6. I came back from the US to Britain at the end of the decade, and by that time the yield on the index gilt was a little over, it was around 2.5, I think. It more or less halved over to that during the 1990s. And during that so-called boom of the early part of the following decade, they fell further. And even at the peak of the financial boom in 2006-07, that rate was 1.5. Now, it has fallen a lot further since, and across the advanced world, real, indeed nominal bond yields in many jurisdictions are negative. But this is a trend that began long before the financial crisis. There were discussions, I think, even in 2004 and 5 about savings gluts. I think there's been a big role since for increased risk aversion and what that's done to the value of government debt in many countries. And I, for one, am always very wary, therefore, about terms like normalization, as if somehow the level of interest rates that central banks are setting should or will necessarily go back to some statistical average that prevailed in the decade or two before the financial crisis, because I don't think the trend is due simply to the fact of that crisis. If you accept that that's a structural thing and that it's going to be with us for a while, I think, as I say, that presents a challenge to any monetary policy framework. Flexible inflation targeting is about as good as any. It looks very similar in its effects to targeting the growth rate of nominal GDP. It's true, it's different in our models from targeting levels, whether that's a level of nominal income or level of prices, but it can be made sufficiently flexible that you could do that in these kind of make-up strategy senses. And those, of course, will, in their turn, rely on being credible. And it's that credibility that's the critical thing. Whether the creation of this particular framework or rule creates that, I don't know. Maybe it's connected with the way expectations are formed that John was talking about. Many central banks are talking about ways we might improve the way in which we set monetary policy. My only point is a slightly pessimistic one, which is that any framework you consider will be problematic in an environment in which the neutral, real, risk-free rate is as low as it is currently. And any framework that hopes to overcome it will rely on the credibility of being able to promise future inflation when current inflation is low. I'll just leave it there.
Thank you very much, Ben. I'm getting a little bit depressed here when people talk about mature generation, and the benchmark is if email existed. When I finished my degree at Chicago, probably one of the latest classes where you had to hire the secretary of the department for her to type your dissertation. So in my case, not even word processing was in vogue. So please stop about talking about mature generations. In any case, well, John, one interesting thing that you are going through is that the Fed is reviewing monetary policy framework, your monetary policy frameworks, trying to refine the use of unconventional policies and by exploring the effectiveness of alternative strategies. So how effective can these revisions of the monetary policy framework be in view of the limited space available for the unconventional tools and the uncertain effectiveness of alternative strategies in steering inflation expectations?
Well, yeah, it's absolutely right that the Federal Reserve, the FOMC, is in the midst, and I would say in the middle, actually, of the monetary policy review, and that's an ongoing process. So my remarks really, I'm going to be trying to take a step back and think perhaps more about what are the lessons learned and maybe some from the experience of the past few decades, and obviously not speak to specifically where this review may end up, because it's still still got quite a bit of time before we finish that. So I think it's important for all of us to think about why flexible inflation targeting has been so successful since it was first introduced 30 years ago by the Reserve Bank of New Zealand, and how an evolution of inflation targeting any evolution of inflation targeting really needs to build upon and strengthen the foundations from the success from inflation targeting. So there are three key ingredients that I view have been key to the success of inflation targeting, delivering price stability. One is that central banks are accountable for achieving the inflation target. The second is the transparency around that. And third is the importance, again, of anchoring inflation expectations. So when I think about this new world that we're facing with very low neutral interest rates, or R star, globally low inflation, and the lower bound on interest rates, I think the same three principles that made inflation targeting successful in the past 30 years will continue to be vitally important as foundations for any evolution of inflation targeting in the future. In fact, I would argue that the challenges of low R star and low inflation and lower bound, if anything, make these three foundations even more important to the success of the policy strategies going forward. So let me briefly comment on that. So first of all, on accountability, I've already mentioned the research that highlights the fact that expectations depends on deeds, not just words, and persistently low inflation has contributed to declining inflation expectations in the U.S. and I think in other countries, and of course does risk unmooring inflation expectations at too low a level. Second is the transparency, that one of the experiences I think we had in the U.S., I'm sure others can share their perspectives on this, is that being at the lower bound, using what were then called unconventional policies, which are no longer unconventional, but communicating monetary policy in that period was very challenging at the lower bound using these other tools, given the limited experience we had with that, and of course the challenges associated with forward guidance in general. And the third is inflation expectations. The focus on maintaining inflation expectations at the target level is just, I think, vitally important in a world of very low R star and globally disinflationary pressures. So thinking about so-called makeup policies or other modifications to flexible inflation targeting. So I think first and foremost, we should be focused on making sure that the enhanced accountability, transparency, and effectiveness at anchoring inflation expectations. I think that brings you to three key, I think, ingredients to thinking about makeup policies. One is they need to be designed to deliver inflation at the target rate on average. So they take into account the effects of the lower bound and other constraints on policy, and will still be expected to deliver inflation on target despite those challenges. Second, the policy actions associated with the strategy and the communication of those, including forward guidance, are consistent with the policy strategy. So having alignment between the framework, the strategy, and the actions and the communication, I think, are vitally important. And third is that I just think a key part of this is that inflation expectations remain centered at the target level. Now, so much is made, and we already heard the word credibility used a number of times, much is made of the question, can central banks credibly commit to future actions and outcomes? And that's a critical part of makeup policies. If you look at the papers on this, makeup policies all work off affecting expectations, either of interest rates or inflation or output. But here I think the experience, I'm more optimistic about this, and I think the experience of inflation targeting and the experience, especially of the past decade, I think provide encouragement. Despite initial doubts from 30 years ago, central banks have been successful at their commitment to achieve low and stable inflation. If you go back to the 70s and early 80s, I think that was seen as a question mark. But central banks around the world have proven that you can credibly commit to a long-run inflation goal and achieve that. In addition, the use of forward guidance by many central banks, including central banks here represented here at the table, has had a clear and direct effect on policy expectations over on a horizon of up to several years. So it's proven to be a powerful complement to policy actions in the vicinity of the lower bound. And again, I think the critical thing is it's about being accountable to your goals and transparent about how you're carrying out your policy actions and communications in a consistent framework to achieve those goals. So to my mind, like with inflation targeting, which actually, even though we can list dozens of countries who've practiced inflation targeting, they all do it in slightly different ways. I think the details of the specific approach, thinking about makeup strategies, matter less than getting these principles right. And of course, they depend on the specific circumstances in different jurisdictions. So what's more important to me is the overall framework be consistent with achieving well-anchored inflation expectations and achieving inflation on average at the target. Getting the strategy, the policy tools clearly communicated and implemented in a way that aligns with the framework for maximal success is really what's important. So to my mind, we like as economists, and I personally like to debate all the different makeup strategies, and that's part of what's fun being an economist and central banker. But to my mind, the lesson of inflation targeting is much more about these principles around accountability, transparency, and anchoring inflation expectations, and then having the policy framework and tools that support that. So I do think, importantly, though, that flexible inflation targeting, although it's been very successful, that the facts on the grounds have changed. The very low values of the neutral interest rate, disinflationary pressures around the globe, the lower bound, is a very different environment than we were dealing with 30 years ago. And so the means to achieve the desired ends have changed as well. Thanks.
Thank you very much, John. Well, quantitative easing has been a very well-used instrument in the last decade. So, as a matter of fact, in many advanced economies, central banks' balance sheets have reached historically very large levels and provided multiple and versatile instruments able to address disrupted market segments in a targeted way. At the same time, their massive use has induced price and other distortions and adverse side effects and potential adverse, for example, in terms of financial stability. So here the question is, what is the desirable size and composition of central banks' balance sheets? So let me start with Phil. Looking beyond the critical phase when facing deflationary pressure, should central banks revert to slimmer balance sheets? Or do abundant central bank reserves play a useful role in money markets, especially in an environment of safe asset scarcity and increased demand for liquidity due to changes in regulation? What are the key determinants of the desirable size and composition of central banks' balance sheet?
So I think as you set up that question, I think it's fairly obvious that really there's two different elements conflated. One is the role of the balance sheet in monetary policy, and then second is the role of the balance sheet in providing liquidity services to the economy. So, obviously the ECB has been quite active in using the balance sheet for monetary policy, whether through refinancing operations, which in the current generation are the targeted lending program, and then also through the role of our different asset purchase programs, which of course is not just the sovereign program. We have the corporate debt program, covered bonds, ABS, and so on. So we remain, we think the evidence remains there that it's quite an effective monetary policy, both quite effective in monetary policy. Now, of course, this is very specific to the nature of the financial system in different countries. So what the evidence for the EU area does not necessarily mean it's carry over in the same way to the US, to Canada, or the UK. For example, we see the asset purchase program as really quite effective, but maybe that's because the bond markets in Europe are quite thin and illiquid. So when we buy, it has a big price effect. Whereas, of course, in the gigantic treasury market in the US, that maybe the kind of price impact of the central bank would be different. So we, and by the way, we don't particularly think there's any kind of diminishing effectiveness. You know, we've obviously in recent months or in recent weeks have restarted the debt purchase program, but our assessment is it's that the APP is still working and the targeted lending program is still working in the way that we had ex ante assessed. So then, you know, I think the question is, these, of course, it remains the case ideally for the reasons Augustine mentioned, the distortions, the kind of fact you are crowding out private sector activity and so on, is the ideal is the nirvana is you get back to a world where you can just rely on the policy rate from monetary policy. So if we were in a world where everything was good, inflation was back to normal, we had raised rates successfully and we'd run off the balance sheet. That, you know, from a monetary policy point of view, going back to a world where just the policy rate was being used would be great. But even in that world, you may decide that maybe the central bank should be a good provider of liquidity services. But of course, then the nature of the balance sheet is different. You wouldn't be buying the long end. You'd be buying short-term securities to provide those services. And I think it's a really interesting question, and is a little bit in Ben Bernanke's the text of his speech last night, is what is the normal state of affairs? Because the world where we lived in before the global crisis, where there's a lot of private manufacture or so-called safe assets, what was that? The optimal? Was that the social optimum? Or maybe the social optimum has more of a role for central banks. And there what's really interesting is how we're going to find out the answer. So, you know, this year with the targeted lending program, for example, we, in our original conception, when we originally were looking at it, we were going to price it a bit more meanly in order to see could we reinvigorate the interbank market. But then for monetary policy reasons, we kind of made the pricing more generous. But I suppose it's going to be a search process, you know, that how much can be done by the interbank market, other liquidity providers versus central bank is, I don't think we can sit here today and have a very strong fixed answer. It's a little bit, it's going to be demand driven as well. But there's a real tension here because you might say it's safe for the central bank to be a big provider of liquidity. But how are you going to undertake that search process to see how much the private sector can do, except through a little bit of trial and error? But of course, always with the safety net, the central bank can step in as needed. So, you know, I think, Augustine, I mean, the question covers two entirely different topics. You know, the monetary policy topic, and then the liquidity services topic. And, you know, I think it's probably best for everyone if we just keep them pretty much separate.
Thank you very much, Phil. Ben, so can further increases in the size of central bank's balance sheet boost aggregate demand? Are we close to the point where the costs in terms of market distortions outweigh the benefits in terms of macroeconomic stabilization?
First of all, I'm just going to reiterate what Philip said about these different functions, if you like, of the balance sheet, and to be careful, therefore, about, just as with interest rates, one can't say, unfortunately, that a particular level is expansionary or contractionary relative to some fixed number, because it depends where this R-star thing is. Similarly, I'm not sure you can say a particular size of balance sheet is either expansionary or contractionary. And to put it in Philip's terms, the demand for liquidity, if you like, the demand for central bank reserves after the crisis is a very different thing, much bigger than it was before. Central banks will, if you measure it purely in terms of size, will be living with larger balance sheets, I suspect, for a very long time. And to go a little bit further with Philip's point, just about meeting these liquidity services, I feel reasonably comfortable, I think, with the idea that more of those services will be provided by central bank reserves relative to, say, interbank lending or repo than was the case before the crisis. I have some sort of Friedman rule type instinct in my head which says I'm perfectly happy with having a slight superabundance of central bank reserves for those purposes. And as to how one finds out how much is enough, I'll just say I'm quite happy that the Fed is going first with its QT, and we can all learn from the US as to how much is enough or not. And obviously, it's sort of, while it's incipiently, when you get a little rise in those interbank rates, that you might be discovering that you're reaching the point or ending the satiation of reserves, the kind of point you want to be at. The thrust of the question, though, is about pure QE, about the monetary policy, the monetary easing source of expansion in the balance sheet. Philip suggested maybe that's associated with using reserves not to, or backing them not with short-term assets, but going into the government bond market and buying longer-term assets. And I think it's almost by its nature the case, by the nature of QE, that those effects can vary according to economic conditions. Philip pointed out one, when markets generally are very liquid, and one suspects the effects of central banks' interventions on prices will be smaller. Happily, that would tend to mean that when you need QE to work the most in the teeth of a crisis, when liquidity in private markets is very low, probably the effects will be slightly larger. It will depend critically on the communication that central banks use to accompany the measures. They signal about keeping interest rates low in future. So I don't see any particular reason why quotes there are diminishing returns per se. I don't see it's the sense that somehow having a large balance sheet now means that every marginal increase in the balance sheet unconditionally is less effective than the last. I don't see why that should be the case. I can certainly see why the reasons why QE will do more at some time than another. And it is important to point out, obviously, that if these channels, all of them rely on reducing forward interest rates somehow, then of course there may be zero lower bounds for those as well. They may not be quite as constraining as right at the front end, but there may be. And that is obviously a source of diminishing returns in some sense. But I can't think of a reason why intrinsically having a large balance sheet now means the next pound or dollar of purchases or euro of purchases is weaker than the last. I don't see why that should be true.
Excellent. Thank you very much. Now let's move to the last question. How should fiscal and monetary policies interact when policy rates are at the lower bound? I have to say that we have been witnessing for the last years an increasing chorus of calls for a larger fiscal policy role in stabilizing economies. Just a few weeks ago in a speech, Mark Carney said something that stuck to my mind. He said, global liquidity, in the context of a global liquidity trap, not only monetary policy should do whatever it takes. And I share that view. So to address this, let me start with Caroline. So how can monetary and fiscal authorities actively coordinate without endangering central banks' independence? What is the experience of Canada in this respect? And what other forms could monetary and fiscal policy coordination take place?
Sure. Well, for the reasons that Augustine just talked about, the role of fiscal policy is indeed very important when we think about a modern monetary policy framework. And to some extent, it's quite a practical matter in the sense that if we have less firepower with respect to our conventional tools, then the obvious thing, as other central banks have done and continue to do, we need to extend our tools, for sure. But even with that, one has to ask, well, is that the optimal policy mix? And is it sufficient? And so we also need to consider how fiscal policy might, if that's needed, help achieve the monetary policy objectives to reinforce macro health, to help us achieve our inflation objectives, but, of course, without creating unsustainable fiscal situations. It's quite an ask. And it's also a matter of governance. So there's this niggly governance question about central bank independence, which I think everybody at the table here would think has served us very well in terms of achieving our objectives and also the trust and confidence of the public. Now, in my view, the clearest mechanism, if you can do it, is to preserve central bank independence while engaging in fiscal authority by having a clear and formal agreement between the government and the central bank on the monetary policy objectives. And that's clear and formal is one part, but I think the other part that's important is that this agreement is regularly reviewed. You kick the tires on whether you all think you're still doing the best thing, and then you renew you tweak if you need to, and you renew that commitment. And that's exactly what Canada's done since 1991. And I don't know if we could have imagined back then just how important it's been. We've renewed it 6 times with governments of different stripes, and we've tweaked it here and there, and we're doing it again. Now, the solution to this need to maybe work together from a fiscal and monetary policy point of view can't involve the transfer of fiscal authority to the central bank. It just can't. I think that would be the first and quickest route to losing your central bank independence. And it can, of course, be transferring monetary authority to the fiscal authority either. And so what really needs to happen is that some work beforehand is done as much as feasible to have the tools sharpened, both the fiscal policy tools and the monetary policy tools, so that if each party decides, they can be deployed in a timely way, in a way that's complementary and most effective for achieving the objectives that you've set out, which in our case is inflation. I think that's why it's just so important in our background work and our background research that we relook at fiscal monetary policy mixes under different scenarios, just to see how an optimal fiscal monetary policy set of tools might look. And of course, we throw into that the macroprudential policies as well. I think it's clear in any real situation that the Bank of Canada or a central bank would retain their operational independence with respect to their own tools, and the same would obviously be true for the fiscal authority, keeping in mind that the fiscal authority is going to have multiple objectives, not just one. But at least one of those objectives is going to be aligned with the central bank, and that's kind of where I started. Now, in terms of other approaches that I think we should be considering collectively, everyone, and I'm taking, here I'm not trying to do the government's job for them, but as a central banker and an economist, I'm just going to put them on the table. And the first one is really just to get creative with respect to automatic stabilizers and how we can boost them. Because aside from just maybe better macroeconomic properties or outcomes, it would be easier to coordinate the monetary and policy frameworks so it happened automatically as opposed to having to take decisions in real time. The second way is to strengthen the macroprudential frameworks, which I think are, in their early stages, if I can put that way in terms of understanding of the tools and as well as the governance structures. But if you can control credit cycles, you'll probably have less of a need to do extraordinary things in deep recessions. And I think the final thing that I would say is that we should avoid being distracted by ideas like helicopter drops or modern monetary theory. I think instead we should be focusing our energy and our political capital on effective fiscal and structural policies that are going to boost demand, but also boost the trend line in economic growth, because that's what's going to make our job easier. It's what's going to make the economies and people in them more prosperous.
Thank you very much. I share your view about MMT. It's not modern and it's not monetary. So, so let's move now to Masasumi. So what have you to say about the fiscal and monetary policy coordination?
Right. I think the last session, the previous session showed that now, of course, when we talk about macroeconomic policy, that we should talk about monetary policy and fiscal policy. So in that sense, it's a kind of standard exercise to think about the policy mix. And also, under the current situation where the nominal interest rate has been very low and negative for Japanese case and European case too, then it is quite natural that there will be some call for the more policy mix and call for more fiscal policy. I think when a possible large-scale downturn or negative economic shocks happens, such a sort of a policy mix should be one of the options when macroeconomic policy is examined. So that's true. But having said that, I would like to point out the following. So first, I think that the monetary policy and fiscal policy have their own sort of objectives. Okay, I have talked about sort of the dichotomy between the nominal and real variables, but I think that if we still keep that framework, that the price stability is assigned to and has been assigned to central banks rather than to the fiscal authorities. And of course, fiscal policy can affect prices through the impact on the output gap and also possibly on the impacts on inflation expectations. So in that sense, that I do not deny that the fiscal policy may have impact on the price development. But also, that if we stick to the traditional demarcation, I think that the central banks should be the main sort of responsible player in determining inflation. And in fact, that has been the case, I think, throughout the history. So, and also that the monetary fiscal policy mix may raise questions regarding sort of credibility and sustainability. Now that in Japan, we have large public debt to GDP ratio, and the interest rate has been so low. And so we have a heated debate about sustainability of Japanese fiscal situation. Some argue actually the Japanese government has assets, and so net sort of the debt. So the gross minus, so the gross debt minus the gross assets is smaller. And some will say, that R is less than G, so that's the Doma condition applies. And some will say, that Japan can still raise taxes so that we can, that accommodates their fiscal needs in the future. But I think that's the very important when we talk about policy mix or sort of the coordination or cooperation between monetary and fiscal policy. It's important and even desirable to think about sort of institutional design of the policy mix. And that's actually exactly happened in Japan back in 2013. So that was a time when the government and the Bank of Japan issued a joint statement. And according to that statement, the Bank of Japan would strive to achieve the 2% inflation target at the earliest possible date. And the government should be responsible for the flexible sort of fiscal policy responses and also consider the growth policy components. So in that sense, this kind of institutional design could help when and if we think about the fiscal and monetary policy mix. And I think that's currently, the Bank of Japan has done QQE, and we have increased the amount of QQE, and we have introduced a negative interest rate policy, and we have introduced now the yield curve control, and we have introduced the forward guidance. And so we have done every conceivable sort of policy initiatives. Now, the yield curve control is a very interesting device because that actually facilitates, or that would be helpful when the government engaged in expansion of fiscal policy. So in that sense, that it's not designed to finance debt, to be clear, but it would facilitate sort of the cooperation between fiscal and monetary policy. And furthermore, the last point I would like to make is that we are talking about sort of declining real interest rate or natural interest rate. And so clearly, I think that we have some need for sort of a growth-oriented policies. Okay, and so that's the one component I think that the government should offer. I think that's a table. Thank you.
Well, thank you very much. Thank you, all of you, for these very eloquent answers to these questions. I see a fair amount of convergence in many of the views. It's not my role to summarize the discussion, because at the same time, each one of the opinions respond to national experiences, and certainly each economy experiences different challenges. So now what I would like to do is to give each one around 3 minutes to see if they want to make an additional comment, or they want to react to something that some other panelists have said. And let me introduce an additional question that I hope it doesn't require a lot of elaboration, but for me, something that I think has made the process of that has made our lives in central banks far more difficult, and I think generated additional complexity to the whole issue, and that has invited also part of the revisions of the monetary policy frameworks, is the presence of the trade debate. I think since 2016, a lot of additional complexities to monetary policy frameworks, to the goals that central banks are pursuing, have become far more complex, and it raised tremendously the stakes. So I just want to know if, I mean, it doesn't need to, I don't want you to elaborate a lot on this, but just to say, do you think that that was a structural shift in all this process? I mean, would we have converged, I would say, to something more solid at this stage in the absence of trade debates? Because I think this is also very important to see how very particular issues can impose a fair degree of complexity to the conduction of monetary policy. So let me start in alphabetical order then.
Yes, it's interesting about the trade debate. I mean, I would, at least certainly in terms of what we've been talking about this morning, put it into the context of something else that could potentially lower yet further the value of the structural real interest rate. As mentioned earlier, this has been falling, or I think there's strong evidence it's been falling for a generation, not just since the crisis. And much as the early debate suggestions as to why that was the case were to do with sort of desired saving rates, particularly in the emerging part of the world. Since the crisis, I think one of the things that is evident does depress it further is sort of risk aversion, more particularly worries in the minds of people in financial markets and indeed elsewhere, that something very bad could happen in the world economy. Mm-hmm. And if you revise even further downwards your impressions of the worst sort of thing that could happen to output, that can have pretty powerful effects on the price of safe assets and increase further the wedge between the sort of rate of return required for risky investments, which is what gets growth going, and the rate of return you need or will accept on government debt. And I think in general, if the political environment is one where suddenly you're shaken into thinking there could be quite potentially very bad things happening to global output, and clearly in the case of trade, there could be some nonlinear effects where suddenly there are big parts of some economies certainly that might suddenly become infeasible if there are sufficient restrictions on trade. I think that could affect, it could be something that's been contributing to the continuing rise in the price of government debt, and that's the way I'd sort of phrase it, but it's not the only thing, because as I say, this is a trend we've been seeing for a long time. And if I wanted to say anything else, it's that to agree with John Williams earlier when he said it's partly semantic what you mean by flexible inflation targeting. If you ask whether you should reconsider it, you might equally ask whether you sort of expand the flexibility sufficiently to cover some of these more novel strategies. I mean, maybe Philip could answer this question. I would consider that what the ECB has already announced as sort of conditional further QE until such time as inflation has risen some level, you might consider to be a sort of make-up strategy, even if it wasn't written down as a general rule, or at least it's certainly a conditional forward guidance of the sort the ECB hasn't done before. I would still put it under the rubric of flexible inflation targeting. It's tactics, maybe, and strategy, rather than a change in the formal rule. And therefore, the obligation to do these things, the need to do them, all arises from this stuff that's pushing us down against the zero or effective lower bound. And I don't think there's any magic bullet there. All the answers, whatever we come up with, rely on people believing the ability of the central bank to commit to, as Tom says, low policy rates and or higher inflation over the future. And let us hope that the track record we've had so far of the last quarter century, which has been I would argue, reasonably successful one, will be enough to ensure that that's the case.
Very good. Thank you very much. Philip, please.
So I think, let me make maybe 3 points. One is going back to question 2 here, because I don't know if we gave a full answer about how central banks affect inflation when inflation is low. So one, I think a necessary condition, and which John and others have mentioned, is you do need a coherent framework, but you also need that your policy actions reflect that. So if you like, and Mario Draghi, for those who were in the previous session, when he was speaking through the video link, since 2014 onwards, the ECB has been basically quite creative in saying, listen, we do have a very firm commitment, first of all, to avoid deflation. So that was wave 1 in 2014, around then. And then over time, for a while, the inflation was climbing and inflation projection climbing also. And then this year, when that kind of went into reverse, maybe because of the global trade shock, we had to move, because to say, well, we want inflation to get to the target, but when we see a downgrade in the forecast, we're not going to do anything about it, that would be inconsistent. So we did have to make a policy move to basically say, listen, we have a coherent strategy here. But I think maybe in the discussion this morning, we maybe haven't said enough about, well, mechanically, how does it work? So I think it's very important is what we're learning is the short-term rate is not a sufficient statistic for financial conditions. That whether through forward guidance, through targeted lending, through asset purchases, if you move any part of the yield curve, it does lower funding costs for the economy. And we see that. I mean, the banks are competitive. They may dislike having to pass through lower funding costs, but they do, because if they don't pass it through, they lose market share. So we continue to see, whenever we provide accommodation, we do see a reduction in funding costs facing the economy. Larry Summers this morning was a bit pessimistic, at that basic level of can we affect the funding costs facing firms and households. It remains the case, we see that pass through. And then it is the case, and again, it's important to say, and you were saying also in relation to Japan, inflation has moved upwards. Compared to the concerns about the euro area moving in towards deflation, once it was clear there's a framework committed to maintaining inflation, the instability of inflation expectations at that point was reversed. And what we've seen is slow, but then eventually a lot of closing of gaps. So the amount of slack in the euro area economy, for a long time there's this wage puzzle. Why, given that unemployment is falling, why don't we see wage inflation? Now the wage inflation dynamic looks in line with historical patterns. Once the labour market gets tight enough, wages do go up. You still face the risk of inflation de-anchoring. And then for pricing, what's interesting is you do have to think about broader measures of slack. Because, of course, it'd be nice if you just had a wage plus a fixed markup equals the price. But in fact, when you have, and this is where maybe there's a divergence between manufacturing and services. So manufacturing, there's a lot of global competition, so where the globalization hypothesis comes in a little bit. That doesn't always work, by the way, to be a negative force. If you have a booming world economy, then manufacturing prices will go up, even if the domestic economy is depressed. But it does mean when you have the uncertainty, and our modeling is the uncertainty about the trade regime is having a big pause effect on pricing in manufacturing. But then also, one of my favorite ideas I'm working on is when you're running this big current account surplus, when expenditure in the area is running far below income, then the pricing pressure, if you have to convince the world to buy your product as opposed to convincing local consumers, my hypothesis is that probably makes a difference to pricing power in the euro area. And so, when you think about this divergence, there's always a divergence between services inflation and manufacturing inflation, whether it's Balassa-Samuelson, non-traded, traded, and so on. But I think it's particularly relevant at the moment. But that's not necessarily forever. But let me again go back. We are seeing, when we look at measures of underlying inflation in the euro area, they've gone up quite a bit in the last couple of years. It's still too low. There's a journey there, but to say it's invariant, it's a constant, it's not true. It's gone up quite a bit, and there's still more to do, like in some other places. But we remain satisfied that the basic mechanics of monetary policy still operates. That's not to say, factors like fiscal would make a big difference. But in terms of mechanics of monetary policy, we observe it. We spend our days and weeks observing if it's working. We do think the basic mechanics remain in place.
Thank you very much. Matsusumi, please.
Yes. About the makeup strategy, I think that the Bank of Japan doesn't have sort of makeup strategy per se, but we do have a sort of overshooting commitment that says that we are going to keep increasing the monetary base even we reach at the 2% inflation target. So by implication that we are not going to sort of contract the one component of the monetary aggregates, that's even after we reach the 2% inflation target. So that would make some sort of a makeup component to our current framework. And also the 2 points I'd like to add is that the labor market dynamics is quite intriguing and important. Thanks to partly thanks to the sort of expansionary macroeconomic initiatives after 2013, I have talked about the labor market ice age generation, but it's no longer true. I used to be a professor of economics, and so I knew that how bad the situation was for the entry level labor market. That's no longer the case. So what happens in Japan, or what's happening in Japan, is that we have actually generated lots of employment, and then female women and elderly are entering into entering back to the labor market. That would actually have a sort of downward pressure on the wage dynamics, but that's is a kind of desirable sort of outcome of our policy. And remember that when we talk about the people can live up to 100-year-old, and also our pension system must be taken care of. There's the great need for people to work longer and healthier. And in fact, actually, the elderly people right now in Japan or over the world are becoming healthier. So in that sense, that's the expansion of monetary policy is delivering some sort of structural changes. And speaking of structural changes, I think we have to think about the declining natural rate of interest very seriously. I think that the main culprit is always kind of demographic change. But we should not really overemphasize that aspect too, because precisely as I said, the elderly can, to work longer, and also, the demographic change may and also does affect the inflation dynamics and the natural rate of interest. The important thing is that we can think of sort of other factors, and we should not really just focus on demographic changes. We should think about, for example, digitalization, and we should think about the rise of robots and the artificial intelligence, all those sorts of technology changes. And I'm not quite sure that, that's well, actually, according to the BOJ staff, the estimate that even Japan's the declining natural rate of interest, I think that the demographic change can account for mostly, I think, the most case, 40% of the decline. So the 60% must come from other factors. So I think that's extremely important to think about the declining natural rate of interest, but not just on demographic change, but also other sort of structural factors.
Thank you very much. Caroline, please.
Thank you. Well, I thought it was the right time to be renewing our inflation control agreement, and I'm even more convinced after hearing all the panelists. And in Canada, we're thrilled that other central banks have jumped on, in the sense that there's so much expertise with the economists working there, with their own experience, especially tools. Canada never had to deploy these balance sheet tools in any way. We provided liquidity, which I agree with you, Phil, is a separate issue, but we didn't do quantitative easing or anything else. And so that work is just fundamental for us. I'm struck, and our staff has been struck just by how different in some sense Canada has been, particularly over the last few years, in the sense that we've had less trouble getting inflation back to target. And so obviously that's lovely, but we want to know why. And does it reflect anything that we can count on in the future? And so a lot of work has been devoted to that, and there are some explanations. I mean, we can see that the relationship between our core inflation measures and measures of the output gap are still correlated with a lag, maybe less strongly than before, but enough to have brought inflation back to target over the last 4 or 5 quarters. It's core inflation is also there. It could be, we didn't have as big a recession as everybody else. It could be that inflation expectations are more strongly anchored at 2%. It could just be the simple fact that, like some other economies that have a flexible exchange rate and are small open economies, that we get a little bit of a help from exchange rate pass-through on total inflation, which can also help anchor inflation expectations. So that being said, you never want to count on the past or the future looking like the past, and you need to take other countries' experiences very seriously, particularly in an environment where you have so much uncertainty and drag on demand coming from the trade war that could, in fact, push the global economy into a more serious slowdown than we've seen over the last year, in which case we'd be in the same boat as everybody else in terms of needing those monetary policy tools. And so we need to mitigate the risks that we see ahead without looking at our frameworks, looking at our tools, without creating more problems than we solve. A lot's been said about, I think, John, you're absolutely right, about clarity of objectives and accountability being at the core of this. I'd like to just add another element that didn't come up, but I'm sure it's on everybody's mind, and that's the social and political context in which our credibility is also tied to the trust that the people we're serving have in us. And so it's important, as we review these frameworks, that our communications doesn't just focus on how best can we have forward-looking guidance or those kind of forward-looking commitments, but how can our communications reinforce an understanding of why we picked the framework that we end up choosing, why is it that the tools that we might deploy aren't unconventional and scary, as was said in the previous session, but in fact are useful and helpful terms that tools that are in the best interest of the economy. And so that's why our work's focused on those both sides, having two-way conversations to understand, so people understand more what we're doing, but also we understand how what we might do and what we're actually doing affects people. I'd be a strange central banker if I weren't confident that we can use our tools and our frameworks to achieve our mandates. And what I've heard today from all the countries, Japan and maybe Europe the most, is that it is possible to use the tools and to adapt in a way that does raise inflation expectations and actual inflation. The unfortunate part is it can take some time.
Thank you very much, Caroline. John, you have the last word of this round.
Good. I want to make two comments. First of all, the Bank of Canada has basically set the gold standard for the reviews over these past 3 decades. That's the way I viewed it when we first started considering having the monetary policy review, because it combines all the elements that you said, really intensive research, analysis, discussion around all the dimensions around the monetary policy framework with a focus on achieving the goals set to the central bank. So that's, to me, Canada has been a great leader in that, and having that be a regular process driven by careful analysis, and I think open mind, bringing an open mindset to that. So that's my first point. The second, I think, is really just about the tone across this table, and I think shared by a number of colleagues around the world, that these longer-run structural factors are not unique to individual countries, not specific to one situation or another, but really are global in nature. Whether you think of demographics, whether you think of slow productivity growth, the demand for safe assets, all the various aspects that have affected the low neutral interest rate, have affected our economies around the world. These are shared factors. And of course, in a global financial system, a global economy, even if an individual country doesn't have those specific factors, the fact that we're in an integrated global economy and financial system means that the spillovers affect everybody. I do feel over the last several years that there's been a process of going through the stages of grief about a low neutral rate, and that people have argued specifically, well, yes, your estimates of R* have come down, but that's probably a reflection of the severe global financial crisis, the euro crisis. I've heard in recent discussions over the last couple of years, is it because of the trade disputes or things like that? Obviously, those are all factors that affect the economic circumstances that we're in. But when you go back to at least how I think about R*, I think about it really in a medium to longer term context. And it's not going to be cyclical factors that are affecting that type of R*. It really is going to be the demographics, the productivity, the factors, the structural factors that affect supply and demand for savings and investment. And despite the U.S. economy, the Canadian economy, Japan's economy, the euro economy, the UK economy, all having recovered mostly or even more than recovered from the economic crises, despite the global economy growing roughly a trend, unemployment very low in many of our jurisdictions, we're still seeing no significant increases in estimates of productivity growth and estimates of trend GDP growth, or in the estimates of the R*. So I think part of this process really is for all of us to maybe realize, I think we have come to the realization that these factors are basically the hand that we're dealt for the next 5 to 10 years, and these conversations around these 5 questions and some others are really the ones that we need to be thinking about addressing and preparing, so that in the next decade or so, when we look back, we can say with confidence, yes, we had thought about this, we had prepared not only in terms of strategies and frameworks, but also in terms of our tool set and how we're going to deploy them to achieve our goals as effectively as inflation targeting has done in the prior 30 years.
Excellent. Thank you very much. And now we have still around 20-25 minutes to address questions from the audience. Basically, we can take some questions now. We can. There are some. There is one person there. Actually, I think we can put the microphone there, and those who want to make questions line up there. So I think we can take a couple of questions first, and then move on. Can you please identify yourself before making the question, and go ahead.
My name is Gui Hai from Bank of Canada. So I get a question regarding the flexible inflation targeting. So John Williams was talking about, inflation expectation depend on experience, right? If I apply to this to GDP growth expectation, and I found basically R star can be explained by your long run expectation about GDP growth. And if this is the case, so right now, after 2000, the GDP growth expectation and the inflation expectation co-move strongly, so have a positive correlation. Basically, if you're understanding the economy, it's hitting by demand shock, right? And going forward, suppose if our economy is hit by instead some supply shock, as trade tension or carbon tax. So should our inflation targeting policy take this into consideration? Because if you have a supply shock, basically we're going to have a trade-off between inflation expectation and the GDP growth expectation.
Thank you. Let's have the second one.
Okay. So my name is Ed Keene. I'm with a firm called the Observatory Group. So I would like to follow up on the comments made about the demographic factors that have been affecting both the measures of inflation expectations and the R-star, the neutral rate. Given that these demographic factors probably aren't going to go away quickly, does it mean that that there will be additional downward pressure on R-star? And if so, what does that imply for the viability of the 2% inflation target?
Let's take the third one, and then I'll give the floor to the panelists.
Hello there. My name is Julio Fernandez from the University of Colorado in Boulder, and also work in the finance industry. I guess there's a question that I have is I've been hearing about how risky the market has become because of the policies that some of the central banks have done. So the question is, what's going on first in the repo market and how that impacts the stability on the markets per se? Does the central banks are really helping out or just creating conditions of further instability down the road because of maybe the market gets excited because there's more liquidity coming in? I guess my question goes to what else central banks can do to make sure that we don't have this instability coming down the road in the markets. Thank you.
Thank you. And here we have one last question for this round.
David Beckworth of the Mercatus Center, and this is for the Deputy Governor Wilkins. And my question is, how has the Bank of Canada been able to maintain a small balance sheet given the Basel III regulations? They've created demand for reserves in the United States, helped contribute to the repo problem, but somehow Bank of Canada has apparently seemed to escape some of these challenges.
Okay, so let me give the floor to each one of you if you have something to say, and we move in this direction.
Okay, I mean, I don't think I have a comment particularly about the repo market, but it's an interesting and quite popular comment to make, which is, are we creating so much easy financing that financial risk taking becomes excessive? And I think, there seems to be a big gap between what we're actually seeing, which is, of course, there may be pockets of that, but credit growth is pretty limited in the euro area. I mean, it's welcome, it's positive. And I would like to reinforce the point that Janet Yellen made this morning, which is if you have effective macroprudential policy, it liberates monetary policy because you know that the tails, I mean, the financial risk taking is usually in the tail. It's when the loan to value gets, fairly extreme and other indicators, or the, say, corporate leverage gets too extreme. So it's perfectly viable to me to ease monetary financing conditions to stimulate credit to the economy while capping the financial risk taking through macro-proof. And then the biggest ingredient for serious financial risk taking is not there, which is optimism. I mean, we know from previous mid-2000s or earlier waves that the biggest ingredient in a serious financial bubble is excessive optimism. And that's just not present. And I think someone today was also mentioning the BOJ, even though, a long period now of accommodation, we're not seeing the kind of serious financial risk-taking that, and this goes back to the scarring effects. When you've been through a serious financial crisis, for a while anyway, the memory is there for many people. And then the question about, I do think about this issue, which is the fact that R star is a lot lower than it was, doesn't rule out the scenario where it gets even lower. So it does depend on the balance of the desired investment and desired saving, and also maybe it's not there for the long run, but at least for persistent periods. This also issue about the safety premium, the gap between the pricing of safe debt assets versus wider investment assets. And that is a very interesting question. Which, and this goes back to something I think has been mentioned repeatedly. When we do these strategy reviews, it's basically going through lots of scenarios. And the scenarios, does the answer change if you have an R star of minus 200 basis points versus an R star of 0? And again, in the Bernanke's presidential address, he covers that to some extent. I mean, the answers do change to an extent, depending on where R star is. So, but to say that interest rates now are super low and therefore they cannot get lower is a fallacy, because it does depend on how the world unfolds.
Thanks, Phil. Jon?
I was actually going to make pretty much the same comment about could R star get lower because of demographic factors or other things, and I think the answer is clearly yes. And I think some of the research that's looked at demographic factors going ahead would suggest that that trend could, in terms of that component, could go lower. But I think it is important to remember there is a number of factors that affect desired savings and investment, and they shouldn't take these as all exogenous. These are obviously associated with various policy decisions, and both in labor market policies, fiscal policy, structural policy. So I think that yes, you could see R star go lower because of demographics, but I think there are other reasons that that could either be forestalled or other factors that could possibly offset that. The evidence so far, as I mentioned, is you haven't seen a continuing downward trend, at least in our estimates over the last few years. I mean, you've seen the decades-long downward trend, but that hasn't gone much lower in the last few years. In terms of the repo market, I'd just make one very brief comment of that. It goes back to what Phil was talking about earlier about monetary policy implementation in thinking about the liability side of the balance sheet rather than the asset side of the balance sheet. And the FOMC had decided about a year ago and developed the plan to have an ample reserves regime, which basically meant that we had enough reserves in the banking system that we were really implementing monetary policy decisions, the FOMC decisions, in terms of the Fed funds target, Fed funds rate and the Fed funds target range, in terms of administered rates, the overnight reverse repo rate and the interest rate on excess reserves. And for that system to work smoothly, basically you need a lot of, or ample, is the word of the day, ample reserves, so that any daily or whatever fluctuation in supply and demand for reserves doesn't have a significant effect on the actual secured or unsecured rates. Instead, there's enough reserves in the system to absorb that. We saw the amount of reserves coming down during the last year, and we said this publicly, we were looking to have both efficient and effective implementation of monetary policy, which meant bringing the level of reserves lower than the extraordinarily high level of reserves we had in the previous few years after QE policies, but not bringing them, but wanting them to be at a level that was still ample, so that shocks to, again, to demand of reserves wouldn't have a significant effect on interest rates. In mid-September, clearly we saw reserve levels come down quite a bit. We saw shocks to demand for reserves actually have sizable movements in short-term rates, and as a result of that, the FOMC made decisions to provide an ample level of reserves that was basically at least as high as we had in early September, and I would say back in summer, when this ample reserves regime was working exactly as we expected and want to see. Since over the last several months, including this year end, which we just had, this additional reserves, both through the T-bill purchases and through the provision of repos into the market, has worked exactly as we wanted. It's raised the level of reserves in the market in a way that transitory shocks to demand or supply of reserves are having almost no imprint on unsecured and secured rates, and the ample reserves regime is working as desired. We still have a ways to go to get the level of reserves on a sustained basis at this maintaining it at the ample reserves level without the use of open market operations, the term and overnight repos. But again, that I think is really just a sign that the level of reserves got lower than the ample reserves level. That led to short-term spikes in interest rates. Since then, as the level of reserves has been brought back to, I think, is the appropriate level, we've seen money markets operate very smoothly, and obviously the Fed funds rate be within the range.
Thank you, John. Caroline, please.
I'm going to start with the question that was directed at me with respect to how do we manage with such a small balance sheet. We always have, in fact, and so given how our monetary policy implementation works in our large value transfer system, there are no reserve requirements. We work with a corridor system, and so financial institutions are used to having that system form the incentives for keeping our overnight rate at target, and occasionally we need to do intraday kind of repos or reverses, but that would just be a matter of course. It wouldn't be anything extraordinary, and it certainly doesn't happen every day. With respect to the large value transfer system, there's a very large amount of possibilities for collateral that can be used, including the non-mortgage loan portfolio. And so with the new Basel regulations, the financial institutions were able to kind of outside the system fund that or be able to meet those requirements with the other securities that were available. I think the question about the supply shock and the trade-off is a really interesting one, because it comes down to what the central, for me it does anyway, what the central bank mandate actually is. And so do you have a single-minded focus on inflation, or do you have a dual mandate? And so, I mean, traditionally, people think about a flexible exchange rate, a flexible exchange interest rate, I've got another thing in my head right now, inflation targeting framework as being kind of equivalent to dual mandate in the sense that, well, most of the time anyway, there's a divine coincidence where there isn't any trade-off. But in the case of a supply shock, well, yeah, there is, but you're going to take that into account by adjusting the pace at which you bring inflation back to target. One of the things we're looking at in our current horse race of different frameworks is whether or not if we actually had a dual mandate with different specifications, there's not just one, would it make a difference and a better difference in terms of outcomes? And of course, that research is underway. There's a couple of other questions, but there's more people to speak, so I'll leave them to them.
Thank you very much, Caroline. Masum, please.
Just 2 comments about the target, the 2% figure, and the second one is about the financial stability. I think you know that even with the sort of lowering inflation expectation and declining natural rate of interest, it's quite necessary, I think, to keep some number. And some would argue for the higher target. I'm not going to go that way at this moment, but I think that it's quite important to have a clear goal of inflation target. And it's whenever I saw why this 2% was born, precisely there was a concern about getting to the deflation. And there has been a huge debate in Japan during the 1990s and to the 2013 that should Japan adopt the inflation target of 2% or not? Clearly, I think the answer is that we should have. Okay? And the 2003, the experience after 2013 verifies that. So in that sense, that we can still argue about the sort of the number, which one is the better one. But I think that's given the fact that the economies can get into a deflationary situation, and as I said, deflation is bad. We should keep that number and keep that number higher than 0. Okay. The second one is financial stability. I think that's any central banks. Although the BOJ doesn't have a sort of a regulatory authority in Japan over the financial sector, any central bank is monitoring the financial markets very closely. And according to our sort of monitoring, that we don't see any sort of a sign of sort of overheated asset price reactions. We have seen some in the Japan's, for example, housing market or residential market, but that is very slight. It's based on our estimates. That said, that's just these indicators are just incomplete sort of indicators. So we have to think about other sort of developments. And with the Japan's financial regulator, the Japan's Financial Services Agency, we are closely cooperating with them to monitor the financial markets. I think that Philip is quite right that we need to have some kind of overly optimistic sort of story floating around if you talk about sort of asset price increase or bubble. So back in the 1980s, late 1980s, when the Japanese bubble came up, there was a talk about Japan became the number one, and Tokyo became the financial center of the world. And we don't see those stories floating around in Japan or in Tokyo. So in that sense, I think we are still not at the stage of having a bubble-like financial stability, instability.
Thank you very much. You will have the Olympic Games soon. So.
That doesn't generate a lot of problems.
Very well. Ben, please.
Yeah, I would join the others in disagreeing with the point that these policies have caused great financial instability. I get pretty puzzled sometimes at the extent and the strength of this sort of coverage. If I look at the value, certainly in the UK, I think this is more broadly true in Europe, equities have underperformed bonds for most of the period since the crisis and since these policies were put in place. The yield expected of quoted UK companies has gone up. In other words, the market value of those companies has fallen relative to the profits they're making, even as the yield on government bonds has fallen. So that sort of spread has widened to extremely wide levels. yields and housing markets, rental yields have gone up in the last 10 years, not down. Debt growth, as Philip has pointed out, which is probably the single best precursor of financial crisis, has been low in Europe, not high. And more generally, on a day-to-day basis, again, the correlation between equities and bonds has been negative. So it looks to me like in most of the advanced world, we have been hit by shocks which have increased risk aversion. This is not what you'd expect if all these disturbances came from monetary policy. Would tend to move those markets in the same direction. And the final thing I'll say on this point, because I get a lot of it, and I just simply cannot see the evidence for it, and yet you read a lot about it. And the other day I got someone to look at these stories in newspapers about how QE was leading to bubbles in UK asset prices. And what you find is you get those stories on days after equity prices gone up. Meanwhile, QE has done nothing. You get no stories about the link on days that equity prices have gone down. So that is evidence of something, but it's evidence to me of some sort of cognitive bias, not of actually a real effect. Which is not to say it's possible. We monitor it all the time. It's the whole business. I spend probably more of my time thinking about financial stability, sit on these various committees, and as Philip pointed out, they're very important. But I don't see the evidence for it at the moment. The only other point I'll make is about R star and the hope. It could well go down, but I hope there's, at some point before I retire even, it might have gone back up. Last year, the Bank of England celebrated its 325th anniversary. And we were not founded as a conventional central bank. Certainly there wasn't such a thing really as monetary policy. All money was just metal. And we were founded as an outfit to flog government debt, really. That's what we were there for originally. So we have all these data on yields of gilts going back to 1694 and various maturities. And we also go on our website, you can find a data set which has estimates of the CPI going back to 1200. I don't know what was in the medieval CPI, but we have a number for you if you want it. And if you look at the ex post real return on these government securities, there is an average, right? Looks to be kind of mean reverting. Philip may not remember this, but I distinctly remember one of our teachers saying he thought real interest rates must be stationary because he'd found out that in ancient Babylon, the interest rate was 3%. And that is the number, more or less, funny enough. The average is about just over somewhere 2.5%, 2.75% in real terms. At least for the longer dated securities. Maybe it's about 1 for real short-term rates. So, no, that doesn't mean to say, A, that it couldn't fall further, B, that over the kind of 3-4 years horizons we look at, that there's any particular reason why that longer-term average should mean anything. But I do hope it is a very unusual, historically, a very unusual situation we are in and have been in. We are the subjects of it, we're not the authors of it. We are constrained by these things. But I do hope that over the next decade or two, things will become, in that very, very longer-term sense, more normal.
Thank you very much.
My one comment is there are many stages of grief.
Yes, I have said that. I did actually say something just like I've said about 5 years ago. So.
Well, excellent. Well, we pretty much have run out of time. Thank you very much for your presence here. And please join me giving a hand to our stellar panelists. Thank you very much.